Hi, today we're going to be looking at investing. We'll look at what is meant by that term investing and how does investing differ from savings. We'll talk about how risk and reward are related when it comes to investing, and we'll discuss briefly some of the different options available to you when it comes to determining where you want to invest your money. First, we want to start, though, by looking at the question, what is investing? What do we mean by that? Investing simply means a long-term plan to acquire wealth. So some sort of long-term strategy for converting the money you have now and creating an even greater amount of money in the future. And the way to do that is through the purchase of what we call appreciating assets. That is, things of value that grow in value over time. Most people save or invest for retirement, but you can invest your money for a variety of other reasons. Anytime you want to grow the money that you have into a much more significant amount, you're going to want to be investing. Why investing and not savings? Well, the main reason is because investment involves the risk of loss, and as we're going to see in a minute, the risk of loss leads to the potential for very high gains. So it's important to recognize, though, that investing is not safe. Putting money in the bank is safe. You put money in your account, it's covered by the FDIC. If the bank goes out of business, you get your money back. But when you invest in companies, if that company goes out of business, you lose all of your money. It's also important to recognize that savings is liquid. You can convert your savings account into cash very, very quickly. Whereas with investing, it's a long-term strategy for the most part. And so you want to leave your money in your investments for a long time, which means you cannot just convert it into cash if you need it easily or anytime soon, especially if it's retirement savings, because there are certain rules and regulations about what you can take and when you can take it. And so because the money is not insured and it is not safe, we have to invest wisely. And also recognize that the positive of that is that we have the chance to make a lot of money over time. When we're saving, we'll find that our savings returns are very low. So while savings is safe, it doesn't really help us move our financial future very far. When it comes to risk, there is a direct relationship between the riskiness of an investment and the potential for return or reward. So the riskier the investment, the higher the possibility of a high return. The safer the investment, the much lower return you're going to get. So when you put your money in the bank, it's very safe. You only get 0.2% return on your savings account. But if you were to invest in stocks, which are very risky, you could see a 10, 20, 40, 100% return, depending on how quickly or how much the stock increased in value. You don't want to have just stocks, and you don't want to have just money in the bank. You want to have a variety of stocks and a variety of investment assets in your portfolio because you want to be diversified. You want to make sure that your money is placed in lots of different assets in order to protect yourself from the ups and downs in the market, because some investments will increase in value, some will decrease in value, but when you have lots and lots of different investments, you're protected from any one investment from losing value and causing you to lose all of your money. Think of diversification as spreading fertilizer in a farmer's field. Money is like manure. That is, when it's left in one pile in one investment, it begins to stink, especially if that investment goes bad. But if you spread your money around into lots of different investments, just like you spread fertilizer around a field, it causes things to grow and to grow rapidly. So what are your options for investment? Well, if you're going to save, you can put your money in a savings account, which most people are familiar with. You also have the option of a certificate of deposit. The way a CD works is that banks typically want you to deposit money in their account, into their institution, because then they can lend your money to other people. And when they lend your money to other people, they can make a profit on the interest rate that people pay when they repay the loan. Banks are worried, though, that if you put your money in the bank, that you're going to want your money out of the bank. And because you could ask for your money, they cannot lend as much of it as they might like. So they want to try and get you in a situation in which you will not ask for your money. And the way to do that is to encourage you to purchase what are called certificates of deposit. When you buy a CD, you basically tell the bank, that you're not going to ask for any of your money for a certain period of time, say for 3 months. So the bank knows that if you buy a 3-month CD, they have access to 100% of your money for those 3 months, and you're not going to ask for any of it back. So they can loan it all out to somebody without fear of having to pay you back at any one time. In order to get you to buy those CDs and to give up access to your cash, they have to pay you a higher rate of interest. And so CDs tend to have a higher rate of interest than a savings account does. And you can buy CDs in 3-month, 6-month, 12-month increments or more. And the longer the CD, the higher the rate of interest. You can also put money in a money market fund, which is sort of a hybrid. You can take money out of the account, but there are certain rules and regulations about how much and how frequently you can take money out of that account. And so banks tend to give you a slightly higher interest rate on a money market than they would on a savings account, but the money market tends to be less than what you would get on a CD. If you wanted to invest, that is, put your money into something that could grow more rapidly than just putting your money in savings, then you have some options. One is called stocks. That is ownership of a company. And individual stocks are very risky, and when you buy stock in any one company, you run the risk of winning big or losing big, depending on whether the company grows or goes out of business. You can also buy bonds, and bonds are a form of debt. When companies or governments need to borrow money, they will do what's called an issue a bond. They will ask for people to give them money with the promise of repayment. So bonds are essentially loans for the government or for companies. Savings bonds are another form of a loan to governments. Governments that want to encourage you to pay them money now will allow you to buy, say, a $100 savings bond, and the face value of the bond is $100, but you only have to pay $50. And the difference between what you paid and what you can get for the bond is interest. Treasury securities are another form of government debt that you can purchase and buy or sell depending on whether you want to wait for them to pay you back or if you want to get money up front. Mutual funds are like stocks. Mutual funds are a group of stocks. It's where you hire somebody whose job is to purchase a bunch of different stocks and create a diversified portfolio for you. And you can then buy a share of the fund. And so the mutual funds take away some of the risk of individual stocks by being diversified. And another form of investment that we've talked about in previous units is real estate. You can buy and sell houses and other forms of real estate, and to the extent that they increase in value, you can see the value of your portfolio grow. There are more detailed descriptions of each of these investment options in a resource that is on Blackboard that you can read more about each one of these. If we were to take these investment options and put them on a continuum from the most risky to least risky, or from least risky to most risky, we would say that bonds tend to be the least risky, Treasury securities being the least risky. That we would put mutual funds sort of in the middle because they're a diversified set of stocks. And then we would put individual stocks and real estate as the most risky options, because if you put all your money in one, you're either going to hit big or you're going to lose a lot. If we were to then put them in order based on their level of return, we would find a similar situation. We would say that savings bonds, Treasury securities tend to have a very low return, mutual funds sort of a moderate return to medium return, and that stocks and real estate have the potential for very high return. Now, you're going to want a mix of all of these in order to be properly diversified. You want some money in the bank because it's safe, especially if you want an emergency fund. But you're going to also want to put money into mutual funds and stocks because there's a lot of growth potential there, while recognizing that having some bonds and Treasury securities will provide you with a certain degree of security, especially when the market begins to shrink, as it does from time to time. Regardless of what assets you choose to purchase or how you decide to approach investment, it's important to remember that you should always seek advice from financial experts and get their take on what's the most appropriate mix of financial assets for you and your goals and your willingness to accept risk. And when you do that, you want to seek out people that are known as fiduciaries, people who are paid to keep your best interests at heart. So when you meet with financial advisors, you should feel comfortable asking them if they are a fiduciary, because if they are, they know what that means and they will say yes. And if they say yes, that means that they have to do what's best for you. And if they say no, then you want to reevaluate whether they are the appropriate person to provide you with assistance. When you do buy stocks, bonds, or mutual funds, make sure that you avoid being pressured into buying any one particular stock unless that person who's selling it to you can explain to you clearly why it is good for you. You should only work with financial advisors who are willing and able to actually explain to you what they want you to do with your money, because at the end of the day, it's your money and you worked hard to earn it. And so you want to make sure that the people that you're working with recognize that and appreciate that that aspect of who you are and what you're trying to accomplish. We'll talk more about financing in another class, and talk to you then.